In addition, yesterday we achieved a total reset with China after productive talks in Geneva. Both sides now agreed to reduce the tariffs imposed after April 2nd to 10% for 90 days as negotiators continue in the larger structural issues. And I want to tell you that a couple of things. First of all, that doesn't include the tariffs that are already on, that are our tariffs, and it doesn't include tariffs on cars, steel, aluminum, things such as that, or tariffs that may be imposed on pharmaceuticals, because we want to bring the pharmaceutical businesses back to the United States, and they're already starting to come back now based on tariffs because they don't want to pay 25, 50, or 100% tariffs, so they're moving them back to the United States. I think it's going to be fantastic for China. I think it's going to be fantastic for us, and I think it's going to be great for unification and peace. China will also suspend and remove all of its non-monetary barriers. They've agreed to do that. Well, they're very numerous. But again, to me, the biggest thing that came out of that meeting is they've agreed. Now we have to get it papered, but they've agreed to open up China. It's going to be great for everybody.
The U.S.-China trade truce. Treasury Secretary Scott Bessent and U.S. Trade Representative Jamieson Greer confirming this morning the U.S. and China will both pause reciprocal tariffs for 90 days. The U.S. will now tariff China at 30%, while China will tariff U.S. imports at 10%. Secretary Bessent saying negotiations will attempt to balance the trade deficit.
Neither side wants a decoupling. We do want trade. We want more balanced trade, and I think that both sides are committed to achieving that. We would like to see China open to more U.S. goods.
Joining us now with more on trade is Greg Valliere, AGF Investments Chief U.S. Policy Strategist. Greg, great to speak with you. We got a lot to get to in a short amount of time here. This 90-day pause, where are the tariff rates heading from here? Is the lower tariff rate we're talking about this morning, that 30% and 10%, a floor or ceiling?
It could go a little bit higher. We're in now, Madison, for another 90 days of this. A rumor every day, a leak every day, fighting back and forth. I'm happy to see this agreement, and I'm happy to see the markets up, but I think we still have a long way to go before there's a deal.
Greg, they say the devil is in the details, and previously, as we think about what the phase one of 2019-2020 trade deal looked like, it was $200 billion over 2 years that was anticipated and targeting manufactured goods, agricultural products, energy products, services. How much do you think a deal that may come forward between the U.S. and China will look similar to that, or are some of the categories dramatically shifted in what needs to be addressed here?
Hard to say. I think it'll probably look a lot like the earlier deal. We're arguing over the numbers. As you say, the devil is in the details. So I do think that in the world of trade negotiations, 90 days is not a long period of time.
So with that in mind, will they come to a wide-ranging, perhaps, conclusion after those 90 days here, or do you think there are going to be different phases of trying to get a deal done?
Probably phases. I mean, there's a lot that has been left unsaid. Maybe we'll hear more in the next 24 hours. But what does this mean for Canada? And what does this mean for Western Europe? I mean, there are still a lot of angles to this story that have not been played out. And we have another big crisis that's starting to loom, and that's the decreasing prospects for getting a tax bill.
Greg, that's exactly where I wanted to go with you, because we know that the tariffs are supposed to raise $600 billion in revenue to feed through to $600 billion in tax cuts. If we continue to get headlines of these tariff deals and negotiations, does that negate any chance of those tax cuts coming in? How are you thinking about that?
The prospects for a tax bill have dropped dramatically. I think that Republicans were astonished and angry over the weekend when Donald Trump leaked out that he wants a tax increase on the wealthy. That's not Republican ideology. And I think you've got that. You've got a lack of agreement on how much spending to cut, how much Medicaid spending to reduce. So the tax debate is going to gobble up an awful lot of time in these next 90 days.
Do you think, especially knowing how some of what Trump in the first quarter, essentially, of his Trump 2.0 administration, has really rattled some of the people who were closest to him as well along the way, whether they be CEOs that were really pushing for him, and because they could anticipate perhaps to a certain extent, or at least they believe so, what a Trump 2.0 would look like. And now the deck is kind of totally shifted here. So how does that change some of the calculus from the administration's relationship with corporate America and some of the largest executives that are trying to have the year of the president for their companies?
It's a good question. I do think, though, that there's a positive angle, and that is that the markets prevailed. Trump had to capitulate to the markets. He had to capitulate to big business. He had to capitulate to a lot of members of the House and Senate. The fact that they are now going to act as a moderating influence on Trump is not a bad story.
It's time now for today's strategy session. The FOMO trade taking hold on Wall Street with investors piling into stocks to avoid missing the market rebound. So should you chase the market rally? Joining us now on that, Brent Schutte, Northwestern Mutual Wealth Management Company's CIO. Brent, it's always great to speak with you. So what are you telling clients today? Do they buy into the rally?
I hope they didn't sell into the falling of the market. And so to me, this is a lesson in why you shouldn't try to market time, especially when it's predicated on trade negotiations, which are fluid. This is why you pick a strategic asset allocation, working with an advisor. You stay true to that asset allocation, and you don't panic and sell when other people are selling. And therefore, you don't have to chase and buy on the upside. And so to me, if you are uncomfortable during the past 30 days with your allocation, you should revisit that right now and make sure that you're comfortable going forward, because I'm likely to believe there are going to be back and forth in the future and that we have not heard the end of the trade negotiations.
Brent, I'll take it one step further here. Do you buy just because the president says buy stocks?
No, you take a look at longer term fundamentals and you pay heed to those. And certainly there are opportunities, I think, in the market today. Small and mid cap stocks were not mentioned in your opening there. Those are trading to the upside today quite heavily because they are more economically sensitive and they are cheap. If you are longer term investors, you should focus on markets that are cheap. You should remain diversified. And to me, small and mid cap stocks right now are an area that investors have ignored because they have become fascinated with large cap US stocks only. This is where there are opportunities for people willing to think outside of that area and look 3 to 5 years out. And I think small and mid cap stocks are a perfect place for investors to make sure they are diversified and not just in the US S&P 500.
So do you like small and mid cap over tech at these levels?
We like small and mid cap stocks. They're our favorite asset classes moving forward. We also like international stocks. I think people got a lesson in international stocks not being dead. If you look at the international markets, they are actually up 12 to 15% this year, which is a surprise, I think, to many investors. And that is an area that I think it still has legs going forward because if nothing else, foreign economies have learned they need to stand on their own 2 feet. And they're going to be doing more domestic stimulus like in Europe to help their economies push along also.
How has this year kind of, I don't know, just shifted the entire mindset around what a defensive play for your portfolio is?
Well, I hope the entire year is bringing back diversification. To me, if you look at the last couple of years, we had an extremely concentrated market that has, unfortunately, I think, sucked investors in just to that narrow area. And at least in my history and my time of doing this over the past 30 years, diversification is the one thing that works. And so I would remain diversified, make sure that you own small and mid-cap stocks, make sure you own some international stocks because the future is still uncertain. And the way that you deal with uncertainty is not by being defensive, but by diversifying across different asset classes, because that is admitting that you don't know exactly what's going to happen, which certainly I think we've all seen happen over the past 30 to 60 days.
Yeah, how much volatility should traders be prepared for in the next 90 days amid this pause, and how should they potentially hedge against any of that volatility?
Yeah, I mean, I think you're likely to see, I think, a lot of questions answered in the next 30 to 60 days, especially on does the soft data leak into the hard data? And so you mentioned getting CPI tomorrow. We also get retail sales. I mean, there was an economy that was later in the cycle that we were coming into this. It got hit by tariffs. We'll see how much that actually impacts the hard data going forward, which is kind of going to drive trade, I think, in the next few days. And then the tariffs are going to be back and forth. I don't think this is the final resting spot for tariffs. We're likely to end up with overall effective tariff rates in the low teens, which is still higher than what you've seen in the past 80 to 90 years, which will likely have an impact on inflation and economic growth going forward, both probably in the opposite direction of what you'd like. And so therefore, I think there's going to be much more volatility over the coming months as we kind of sort through all the different issues that are still out there.
Stocks are continuing to climb as the U.S. and China agree to slash those tariffs for at least 90 days. But as U.S. markets celebrate, our next guest says the agreement could be a bigger win for China. Joining us now, Zongyan Liu, fellow at the Council on Foreign Relations. Zoe, thank you so much for being here. So a bigger win for China. Why is that?
Julie, thank you very much for having me. I think this is in fact a bigger win for China, not just because basically the Trump administration over the weekend has nearly undone the Liberation Day tariff over China. But then on top of that, it seems that the whole strategy of building allies to isolate China with regards to building a huge tariff wall to separate us versus China, that strategy seems to not be working because China, our tariff on China, the Trump administration's tariff on China now is only 10% higher.
So Zoe, what comes next, do you think? Because Bessent was talking to press this morning and suggesting he'd be meeting with Chinese counterparts again in the next few weeks, kind of iron out a bigger agreement. What do you think the bigger agreement looks like?
Josh, you are right to point out that Secretary Bessent mentioned the mechanism, and in fact, in writing in the agreement, they mentioned about the mechanism for continued conversation. Now, here is the trick, right? Although some Trump administration officials frame this as if we have reached a breakthrough, we have reached a deal, but you do not see the Chinese call it this way. The Chinese frame this as we made progress in resolving differences, but the Chinese never said this is a major breakthrough. So going forward, we probably will see continued conversation between the two sides. And now we have 90 days for both sides to figure out what they want and what they are willing to compromise. But ultimately, so far, we still see an asymmetry in terms of governance style. On the one hand, President Trump has featured prominently in media. And then on the other hand, President Xi Jinping has never given any comment about a tariff yet.
So, Zoe, I can't help but wondering what the point of this exercise was. Now, we know it's not done yet, so we don't know what the two sides will agree upon. We don't know what the U.S. will get out of it, but the U.S. initiated this. So what does a best case scenario look like, and does it put the U.S. in a better place than it was on January 1st, say?
I'm afraid, Julie, that I'm not as optimistic because, it is relatively easy to undo the self-inflicted tariff rates, but it is very hard to undo the damage that it has done to America's credibility and perhaps to a certain extent the role of the US dollar, not just in the short term, but also in the long run. Now, the best case scenario for American consumers perhaps would be we return to the pre-Liberation Day tariff scenario, but that is going to take a time. And then the better scenario, the best case scenario for American manufacturers is that through a period of time, and this is going to be a long period of time, that American suppliers, American manufacturers, American industries are able to build an alternative supply chain relatively independent of China. But this is going to take forever. And we simply cannot bring all the manufacturing jobs back to America through tariffs.
Zoe, I'm curious to find out more, get your line of sight on what's going on the ground in China right now. I asked because Kyle Bass, Zoe, posted on X yesterday. Let me read you what he said. He said China came begging to the United States as thousands of Chinese businesses shuttered and failed each and every day over the last few weeks. Factory activity, he says, contracted at its fastest pace in 16 months. Widespread factory closures and job losses. Worker protests have erupted in various regions. I mean, that sounds obviously, he's painting a rough picture, Zoe. I'm curious, does that dovetail with your understanding?
Josh, you are absolutely right. There are a lot of these kind of narratives over the past few months, and even since last year, this kind of a triumphant tariff over China that is going to not just crash the Chinese economy, but perhaps through the crashing of the Chinese economy leading to higher unemployment that is going to destabilize the Communist Party regime. And I think is this kind of overly stated triumphant narrative lead to the Trump administration officials' overestimation of their leverage over China. And in fact, what we are observing now is that this is not a tariff war. This is really about who can endure pain for longer. And guess what? The Trump administration's Liberation Day tariff lasted barely for 39 days, which basically means that from Beijing's point of view, they now have a better understanding of the timing of how long the Trump administration could endure the pain, the pressure from American business, from U.S. domestic constituencies. But on top of that, China has also augmented its series of domestic measures to fight back against U.S. coercive measures, including but not limited to export controls. So overall, I'm afraid that a lot of these triumphant narratives led to the mismanagement of the trade relationship with China. I think it's okay to be tough on China, but you ought to be smart in executing it.
So Zoe, was there indeed, though, protests on the ground in China and this sort of groundswell of protest against the Chinese administration?
Protest. This is really in terms of numbers and scale. And we even during COVID time, people and media and social media reported about protest again on Chinese people going on the street, and it has been for a variety of reasons: for zero COVID, for COVID lockdown, for people losing their jobs, for a fire in Urumqi, and now for factory closure, or for people who has not get paid. So people have protested for decades for various reasons, and this is not the first time. And guess what? The Chinese government spent more money on maintaining domestic stability than on national defense. In other words, they understand how to mitigate the domestic risk.
Stocks climbing, as Julie's pointed out, as the U.S. and China agree to reduce tariffs for the next 90 days. President Trump highlighting the reduction in a press conference earlier today.
We achieved a total reset with China after productive talks in Geneva. Both sides now agreed to reduce the tariffs imposed after April 2nd to 10% for 90 days as negotiators continue on the larger structural issues.
Well, here to help us break down the details now is Yahoo Finance Washington correspondent Ben Werschel. Ben.
Hey guys, yeah, so quite a series of rapid fire developments today after this early morning announcement of this 90-day pause from 145% tariffs on the U.S. side and 125% on the Chinese side. One through line today, I think, is we're kind of getting a sense of the key next steps to come as we're digesting this deal. The first one you alluded to at the beginning, which is a Trump meeting with President Xi Jinping. He said that could happen as early as this week. That would be a major moment in terms of kind of finalizing a lot of the underlying issues here that are kind of a bit being glossed over by this tariff reduction, but are really complicated, and they have to figure out at least the next steps on to sort of see momentum continue here. The next is more meetings between Treasury Secretary Scott Bessent and his team and the Chinese. Bessent said today he expects those in the coming weeks, so that could follow quickly. There's a clear desire here on the part of the White House, at least, to keep momentum going here. And then a third one that I think people maybe aren't recognizing enough is the other tariffs that Trump has in the offing that could complicate this story. I think it was important that Trump made a note today that this deal does not include pharmaceutical tariffs, which he said that he alluded to the fact that they are coming. He's promised that pharmaceutical tariffs and semiconductor tariffs will be announced in the coming weeks. There's investigations ongoing on those fronts. So those are coming, and those are going to be big moments in terms of kind of what this overall tariff picture as we kind of have another 90-day clock ahead of us between the U.S. and China.
And of course, he also signed a separate executive order having to do with drug prices. We're going to talk more about that a little bit later in the show. But there's another question I have for you about the China tariffs, which is recently we had the removal of the so-called de minimis exemption, right? That goods worth $800 or less that were being imported into the U.S. had been exempt for a long time from tariffs until, what was it, a week ago Friday or whatever it was. So, so Does this affect that at all? Do we know?
It does not appear to affect that. This is a good example, I think, of if you're in this sector, you're better. You're definitely better than you were yesterday, but you're worse than you were on January 2nd. So the de minimis exception was revoked. It was on May 2nd. This allows these goods under $800 to have duties on them. They will get a decline in their tariffs because of this deal if it's coming from China. So the 145 to 30% is a big break for these companies. These are Chinese firms that would import things directly. But as I mentioned, there's no clarity. There was no mention of the de minimis exception in the joint statement, and the leaders didn't bring this up. So the de minimis exception appears to still be revoked. So you're kind of better than you were a few days ago, but you still are paying duties to the government.
Big tech stocks leading market gains today, with the Nasdaq 100 officially wiping out year-to-date losses. The Magnificent Seven adding more than $800 billion in market value following the deal between the U.S. and China to temporarily reduce tariffs. Joining us now with more, Dan Ives, Wedbush Securities Global Head of Technology Research. Dan, great to have you as always. I know you say this truce is the best case scenario. Which tech stock is the biggest winner within that scenario?
I think it's Apple and NVIDIA. I mean, if you look at this, that was the black cloud, right? I mean, the supply chain hearts and lungs are in China. And as much as you could talk about moving to India and others, this is a huge sigh of relief. And I think it changes our view that, new highs for tech, new highs for the market, now on the table after what we just view as a dream scenario happened this weekend.
Well, Dan, let's talk about Apple a little bit. I know you had a call for a $3,500 iPhone if production was brought back to the United States. What's your call on the price of an iPhone today?
And look, it comes down to I mean, they're going to have to struggle not to raise prices if they don't get exemptions and you actually keep some sort of tariff in when it comes to China. Look, it all comes down to the reality is iPhones need to be made in China. Some can be made in India. They can never really be made in the U.S. Because if you want them made in the U.S., the price points would basically be massive demand destruction on day one. And it would take 4 to 5 years to even build 10% of that in the U.S. So that's why our whole point over the last, call it 6 weeks, was let's talk reality versus fairy tale. And the reality is that iPhones will continue to be built in China, with some being built in India.
How do you suss out the reality versus a negotiation, a framework, a thinking of a deal when there isn't necessarily clarity yet on the goal of these tariffs?
Look, I think ultimately they're both playing poker, and especially U.S., they look at their hand. It's not a good hand, right? And I think they had to move further and further back from the cliff in terms of what we saw with the delay of the reciprocal. And obviously when it came to China, because the cargo data doesn't lie and the price points doesn't lie. And whatever CEOs are saying publicly behind closed doors, what they're telling the White House is you need to change, you need to move. So our view is even when it comes to the 30%, I mean, that's probably the high bar. It goes to call it a reciprocal 15%, 20%. Once you work out WTO, IP, and all the other issues are going to have to get worked out over the next year. Mm-hmm. But you don't want a decoupling when it comes to AI revolution. And I think this was, a potential black swan moment that was self-created that's no longer there.
And Dan, my guest host Lou Bassanese has a question for you.
So Dan, I just want to talk to you more about Apple. I feel like early in the show I said this time of year everyone gets a bit negative on Apple. How worried are you about price sensitivity, right? I mean, the consumer is super loyal to Apple, 2.5 billion devices out there. You got a lot of subsidies. Does it really matter if the iPhone price is a little bit higher than it was expected? I mean, do you really think that impacts demand?
Yeah, no, it's a great question. Look, I mean, the last thing Apple wants to do is raise prices. And they've kept prices basically the same. The reason that is because you have, call it 300 million iPhones that haven't upgraded in 4 years. So even if it's 3%, 4%, 5% of that may be delay for a year because of a $100 increase or $150. That's not what Apple wants, but they're beholden to their supply chain. But when it comes to going into WWDC and iPhone 17 and obviously AI, I mean, this is a key period for them to actually see growth in terms of high single digit, double digit growth, which was obviously evaded, in terms of the Apple story over the last few years.
Dan, one quick follow-up. Earlier in the show, I said the Mag 7 was a boy band like NSYNC that's breaking up. Who would be
And
your...
I love NSYNC.
Yeah, look, who would be your Justin Timberlake, though, for breakout? You said Apple and NVIDIA. If you had to pick one for the best breakout for investors right now, which one are you most optimistic about on the aftermath of these trade truce?
If there was like a Timberlake part of NSYNC breaking out, it would have to be NVIDIA. I mean, and look, Jensen, we'll see what happens with the black leather jacket if he had to, make it to be a boy band. But look, I think the reality is that I think it makes all new all-time highs because there's only one ship in the world fueling the AI revolution, and that's led by Godfather of AI, Jensen NVIDIA.
How big of a catalyst, Dan, is the fact that the United States is lifting some of these sanctions between the U.S. and Saudi Arabia when it comes to chip purchases? We're seeing the shares of NVIDIA up over 5%.
It shows it's not just about China. I mean, think about it. That was not on the table when you look at that whole market. And it's not coincidental that they're in Saudi Arabia this week after, obviously, the U.S.-China, weekend talks with Besant. Because it shows, when you think about AI revolution, you only have 4% of U.S. enterprises going through AI, 0% in Europe, 0% in Asia outside China, and in Middle East, it's baby steps in terms of where we are today. So this just shows what I believe is going to be happening over the coming years. The trillions being spent on AI, and obviously it starts with chips, but think about on the software side, from Microsoft to Google, to Amazon, to obviously names like Palantir, which I kind of view as front and center the best pure play AI name out there.
Dan, let's talk about Microsoft since you mentioned it. A report from CNBC citing a spokesperson with the company that Microsoft is cutting 3% of its workforce. Any take on that?
I mean, I think they're just doing what they do every kind of few years. They're still hiring when it comes to direct sales, I think some of the strategic areas. But look, companies, and we've seen with a lot of big tech companies, they're going to have to continue to focus on strategic versus non-strategic. But right now, it's Microsoft's world, everyone else paying rent when it comes to what we're seeing on core cloud in terms of enterprises. So this is in no way any sort of sign of weakening. I mean, they just had a quarter. That was just a Saquon quarter they posted.
And I also, before we let you go, Dan, want to get your take on Tesla. We saw the share slumping a bit off the back of a fall in Chinese sales, but of course, back up today, perhaps off the back of images of Elon Musk and President Trump together in Riyadh and also the broader market lifting. What's your take on Tesla?
But also remember, Musk is in Riyadh as CEO of Tesla, no longer in terms of my view with Doge, Trump administration. Remember, that dark chapter is over. Now it's about autonomous when it comes to Austin in June. I believe it's the next stage of this massive story for Tesla. And I think, look, they're going into a Jalen Brunson moment. I think it's just the start of what I see as just massive growth. And I think a $2 trillion market cap could potentially now be on the table for Tesla.
Really great overview, as always, Dan. It's always a pleasure to have you. Thank you so much for making the time, and thanks to Lou for joining the conversation.
The NASDAQ Golden Dragon Index, which tracks China companies listed in the U.S., jumping more than 5% following the announcement of the U.S.-China trade truce. So what are the stocks and sectors best positioned to win? Joining us now, we've got Brian McCarthy, Macro Lens Managing Principal Chief Strategist. Great to have you here with us. So let's just dive in from there. As you assess which companies stand to benefit the most and the sectors perhaps that could be targeted for some of the major purchasing agreements between the U.S. and China, which ones immediately stand out?
Sure. Well, it was announced, I guess, last night that Boeing is rescinded their stop on the purchase of, China has rescinded their stop on the purchase of Boeing airplanes. So there's a quick beneficiary. I would assume they'll be coerced into picked up purchases of U.S. agricultural products across the board in coming months if they want this truce to hold. On the U.S. side, the sectors that really got freed up that were subject to that eye-watering 145% tariff were some of the lower value-added stuff, footwear, toys, housewares, furniture, and things like that. And of course, any countless number of small businesses that had cargoes of plushy toys or Christmas tree lights and all that stuff hung up on this 145% tariff. So those businesses will all be given a window of 90 days, perhaps extended, but at this point we know it's 90 days, where they can get those goods into the U.S. at a tariff ranging from 35 to 45%, let's call it, all told. So you're going to see a massive flood of imports in those goods categories in coming months. But all of those businesses are still going to have to struggle with this issue of whether they're comfortable leaving their supply chains running through China in a big way. And I think they're going to find that they're not. So they're still going to incur, I think, a lot of expense in having to figure out how to move those supply chains.
And talk to me then about some of the news we're getting this morning out of President Trump's meetings in Saudi Arabia. The president planning to allow Saudi Arabia to more easily import AI chips from the likes of NVIDIA and AMD. To what extent do you think that those chips could then be sold on to China? And then how does that impact, say, tech names over in China, that they will have a way to potentially get access to those high-powered chips?
Yeah, it's been my contention all along with this chip stuff that it's just really hard to bottle up knowledge, and it's really hard to bottle up these chips we found. I assume they'll have some strictures on the resale of these chips, whether they're effective or not. Who knows? Probably not, because as we've seen throughout the Biden era chip controls, it's just very, very hard to put a net around this stuff. And the Chinese are very diligent. They have a very good network of, ways to move products underground, for all kinds of products. In fact, China is struggling with smuggling of rare earths through their export controls. So it goes both ways. And I think it's just very hard to bottle up the tech in terms of both the hardware and the IP.
So, yes, with the IP, which was part of the Phase 1 2020 trade deal from Trump 1.0 administration, how much more difficult is it going to be in this day and age and in this environment to track and make sure that that intellectual property is not being essentially duplicated or replicated, I should say, within that region, that would then create even more of a competitive headwind for some of the companies that want access into the region, but also want to make sure that they're still securing their own competitive advantage?
Right. On a scale of 1 to 10, it's about a 12 in terms of difficulty. It's impossible, basically. So we're going to hear a lot from Treasury Secretary Bessent and from the president and others about this Phase 1 deal and sort of putting that Humpty Dumpty back together in coming months. And I think your viewers should keep in mind, we can force China to buy more soybeans and buy more aircraft and things like that. But in terms of any of the so-called structural reforms, whether it's cracking down on theft of intellectual property or getting China to reduce its subsidies to the winners it picks in its export sector, or getting China to rebalance its economy to more consumption. These are all complete and utter fantasies. I don't believe the Trump administration believes any of this stuff. We saw that Phase 1 deal went nowhere. It was completely not enforced, but China really, I don't think, had any intention of ever doing anything beyond buying a few more soybeans. So all of that is, it's fake. It's fake news, you might say. But that might not stop it's something the Trump administration can use if they need to sort of justify a punt, which is what they've done for 3 months at this point. Whether it extends longer, there's a lot of variables, that we'll see over the next few months that'll play into that.
Well, consumer prices in April remained sticky despite some signs of cooling, inflation continuing to run above the Fed's target. It's a target that will likely remain elusive as the tariff impact to consumers remains a risk. For more on where the road ahead for inflation is going, let's get to RBC Capital Markets economist Carrie Freestone joining us in the studio. Carrie, thanks for being here.
Thanks for having me.
So the inflation reading, first of all, backward looking, doesn't include a lot of the tariffs, did come in better than estimated. But let's look forward when it comes to inflation, because you and your team don't think that this is the low. You think that we're going to continue to see a trend higher.
Absolutely. I mean, we really haven't seen the full impact of tariffs come through yet. And it was actually surprising this morning because even if you looked at the auto sector, we actually saw a pullback in motor vehicle parts and equipment. And that's something that surprised me. And it's really telling us that, it's going to be a while for firms to change their behavior and for us to start to see an impact on core goods prices. Now, one thing that's positive is obviously the administration's walk back yesterday on tariffs on U.S. imports from China is a positive development. But the average effective tariff rate here in the U.S. is still 13%, which is 5 times higher than a year ago. So while previously we thought core inflation by the end of the year might be 4%, we're now thinking closer to 3%, but that's still quite a ways away from the Fed's target, right? So, the current backdrop makes it exceptionally challenging for us to get to where we want to be.
Karen, I'm just interested with oil at 63, how does that play into your inflation outlook?
Yeah, so we're definitely in a situation where we're going to see downward pressure from energy prices and upward pressure from core goods. So we're in a situation where we're going to see that switch a little bit, and the pressure is really going to be coming through from core in the year ahead. Even today, 2.8% core, so that's where we're seeing a lot of the pressure, and that's something that we can expect to continue to see.
So what does all of this mean for the Federal Reserve, right? Because on the one hand, the tariffs coming off the worst case scenario seem to be a positive development for the Fed's efforts to balance its dual mandate. But then if we are still going to see that trickle through, it's still going to be potentially challenging for them, right?
They're still in a challenging position. At the last meeting, Chair Powell emphasized that, there's time to exercise patience. And I think that's even more true today after yesterday's announcements. But we're still in a situation where, when we see the upward pressure on core goods prices, that's going to result in a real erosion in consumer purchasing power, right? So we could still see, a hit to the labor market, specifically in those trade-exposed sectors. And while, Chair Powell's been non-committal about which side of the mandate he's going to think bears more weight, in our view at RBC, we lean towards the fact that we think they're going to be concerned about higher unemployment. So right now in our forecast, we have 3 cuts baked in the back half of the year. Now, again, it's a fast evolving situation, so things could definitely change. But we do think that side of the mandate is going to bear more weight.
Well, I'm just curious more broadly, Carrie, what's the RBC kind of house view of how the U.S. economy evolves over 2025? With the U.S.-China trade truce, I know you read through all these published reports, there are plenty of economists who are saying, well, okay, our odds of recession risk are receding. Is that your view?
Absolutely. I think the discussion in the near term of recession risks has maybe pivoted for a little bit, but I do want to highlight, we still have 30% tariffs on imports from China, right? So that's still, way worse off than we were a few months ago. And so that is going to hit the U.S. consumer. And while we think that, there is some upside risk to our growth forecast for Q2 and Q3, we're still in a situation where growth is going to be softer this year than it was in the past few years, especially when we were in a situation where the consumer had exceptional momentum. We think that's going to cool off. So, we're not expecting to see a recession this year, but we are definitely expecting to see cooler growth.
I have a 2Q GDP question for you. What we saw in the first quarter was a surge in imports as people tried to get ahead of the tariffs. Then the tariffs got put in place. Now we have this sort of come down of the tariffs to some extent. And there has been some reporting out there that, importers in the U.S. were waiting for the tariffs to come down to load ships up and bring goods into the U.S. So does that mean we also risk in the second quarter seeing another rise in inventory that could then push GDP down? Or you don't think I see from your face you're skeptical. You don't think it's going to be that big of an effect?
I think most of the effect will be baked in Q1. So Q1, ultimately, we think, it was negative, and we think that Q2 is not going to be negative. We're not expecting to see, such a significant buildup in inventories. But again, we don't see, the full impact of tariffs fully baking out in Q2. It likely will be into the summer months before we see that impact on inflation and then growth. And the reason for that is, it takes businesses to time to make decisions to pass off those higher prices. We saw inventories surge in Q1. We're likely going to see that into Q2. And so, we're probably not going to see the higher prices materialize until the summer.
Gotcha.
Carrie, great to have you here on set. Thanks so much for coming in.
Thanks again.
Let's begin things as we always do, taking a look at some of the market action. We're 90 minutes into the trading day. Stocks, they're mixed. Following Monday's rally fueled by the U.S. and China agreeing to temporarily reduce tariffs. Investors now digesting today's CPI report showing inflation cooling in April. Joining me now, we've got Malcolm Dorson, who is the Global X Senior Portfolio Manager and Head of Emerging Markets Strategy. Great to have you here with us. So how are you looking at the state of markets right now? Coming off the rally, we've now seen the S&P 500 essentially get back into territory and perhaps on pace to erase some of the losses that we've seen over the course of this year.
Well, thanks for having me, Brad. Big picture, I think investors are incredibly underallocated within emerging markets. We see the average retail investor has roughly 3 to 5% exposure to the asset class. And if you look at what the benchmark says, you should have about 10.5%. And emerging markets make up 25% of global market cap. So people are dramatically underinvested coming out of a period of really significant US outperformance. And now that we've reached this period of sort of uncertainty, the main questions we're getting at our Global X portfolio consulting group is people are looking for a second set of eyes saying, how do I find diversification? And we think emerging markets is a key area.
And so where within emerging markets are there specific regions that you're looking at?
For sure, because historically people used to be happy buying the index in emerging markets. Right. But now if you take a look at it, it's over 80% Asia, about 37% China, 26% state-owned enterprises. There are a lot of areas within EM that people don't want to touch, justifiably, but there are also pockets that present a ton of opportunity. So right now, we're most excited about, depending on what perspective you want to look at it, but from a long-term structural opportunity, India is a compounding machine. Our fund, NDIA, has been getting a ton of attention. From a value perspective, that I know a lot of investors, not only want to preserve wealth, but they see that as the best way to grow wealth, getting in at cheap prices. Greece trades below book value with a 7% dividend yield, and it's now an investment-grade sovereign with some of the fastest growth in Western Europe. And then in addition to that, we kind of take a look at a contrarian opportunity in Brazil. Yeah. Brazil just hiked interest rates to 14.75%. It's a powerful carry trade. We think that is now going to contain inflation. By the end of the year, rates should start coming down. And historically speaking, in Brazilian rate cutting cycles, the average rally has been 96% versus the average drawdown being 17%. So we really like that risk-reward setup.
What is the checklist for emerging markets amid geopolitical tensions and a lot of the trade talk that still need to be netted out and formulated into deals that we're all awaiting some of the details around?
Sure. So starting out with trade, we think that coming out of the election and his first few months as presidency, Trump's all about the deal, the art of the deal, and the way that he approaches things is through sort of an anchor-based negotiation tactic, where he really likes to weight to one side or anchor things to one side, starting out with sort of a worst-case scenario. And that created a lot of volatility in EM, but it also created windows of opportunity. So whether it was China, Colombia, Mexico, investors who paid attention to this got in quickly and have been able to benefit from the upside. So now we're trying to scan this universe and see who's aligned with Trump's policies and where are we going to see a deal next. So we have this 90-day reprieve with China, fantastic, but India is going to be a very interesting opportunity, and we've seen really strong negotiation outcomes coming out of that, with J.D. Vance visiting New Delhi a couple of weeks ago. We think Argentina, with President Milei, is very aligned with Trump, that we should see some news coming out from the southern hemisphere as well.
When you boil it down to, and even refine further to a sector-based approach within specific markets that you would like to invest in, how do you identify which sectors are best positioned to be a core or pillar of some of the trade deals that we're still waiting to come through here?
So it's a good question because there are two different ways to approach this. From a sector perspective, looking at the deals and kind of from a more tactical opportunity, you'd probably be looking at areas where these countries manufacture and export, whether it be electronics in Northern Asia, whether it be commodities in Latin America or in the Middle East or in parts of Africa, or whether it be pharmaceuticals coming out of India. But that is more tactical. I think longer term, when you're approaching emerging markets, you kind of want to differentiate old economy versus new economy. And EM historically has been kind of making something or digging something and taking advantage of cheap labor, and these are asset-heavy, low-return business models. But looking forward, these companies have evolved. They have really strong private management teams now, and you have a lot of opportunities more in consumption in the services sector, which are offer higher levels of profitability, higher growth, and overall better corporate governance. So long term, that's where we like the compounding opportunity.
Just lastly, while we have you, we know that there, of course, is the meetings that are taking place in the Middle East right now. The president starting his international travels, and a few of the CEOs also tagging along, trying to be not just flies on the wall, but perhaps critical voices in these conversations. What should you be watching for, even as the president is going through these international visits, and where this could net out in some investment opportunities?
Yeah, looking for deal headlines. So the Middle East is very interesting because it seems like Saudi Arabia in particular is really playing ball. Near term, I think that might create a headwind for Saudi's market, but they're long-term thinkers. It's Vision 2030 and beyond. So yes, near term, we're seeing a weaker dollar. Saudi Arabia's currency is pegged to the dollar, so that could be a negative for Saudi and other Middle Eastern countries as well. And same in terms of lower oil prices. But longer term, having a strong relationship with the U.S. is going to open a lot of doors for them, and I think it should be a net positive. So near term, what we look for is saying, okay, this arrangement's being made with the Middle East. Energy prices are coming down. We're seeing some sort of volatility. People are looking at gold a lot these days. Who benefits from that? And that's where I kind of come back to India again. India imports 80% of their net energy needs, so low oil prices really help. The average household savings in India is made up 20% of gold, so consumer confidence is booming. They're now starting to cut interest rates because inflation's come down, and it sets a really nice picture for them.
Interesting. Malcolm, thanks so much for taking the time in studio with us.
Thanks for having me, Brad. Appreciate it.
The NASDAQ Golden Dragon Index, which tracks China companies listed in the U.S., jumping more than 5% following the announcement of the U.S.-China trade truce. So what are the stocks and sectors best positioned to win? Joining us now, we've got Brian McCarthy, Macro Lens Managing Principal Chief Strategist. Great to have you here with us. So let's just dive in from there. As you assess which companies stand to benefit the most and the sectors perhaps that could be targeted for some of the major purchasing agreements between the U.S. and China, which ones immediately stand out?
Sure. Well, it was announced, I guess, last night that Boeing is rescinded their stop on the purchase of, China has rescinded their stop on the purchase of Boeing airplanes. So there's a quick beneficiary. I would assume they'll be coerced into picked up purchases of U.S. agricultural products across the board in coming months if they want this truce to hold. On the U.S. side, the sectors that really got freed up that were subject to that eye-watering 145% tariff were some of the lower value-added stuff, footwear, toys, housewares, furniture, and things like that. And of course, any countless number of small businesses that had cargoes of plushy toys or Christmas tree lights and all that stuff hung up on this 145% tariff. So those businesses will all be given a window of 90 days, perhaps extended, but at this point we know it's 90 days, where they can get those goods into the U.S. at a tariff ranging from 35 to 45%, let's call it, all told. So you're going to see a massive flood of imports in those goods categories in coming months. But all of those businesses are still going to have to struggle with this issue of whether they're comfortable leaving their supply chains running through China in a big way. And I think they're going to find that they're not. So they're still going to incur, I think, a lot of expense in having to figure out how to move those supply chains.
And talk to me then about some of the news we're getting this morning out of President Trump's meetings in Saudi Arabia. The president planning to allow Saudi Arabia to more easily import AI chips from the likes of NVIDIA and AMD. To what extent do you think that those chips could then be sold on to China? And then how does that impact, say, tech names over in China, that they will have a way to potentially get access to those high-powered chips?
Yeah, it's been my contention all along with this chip stuff that it's just really hard to bottle up knowledge, and it's really hard to bottle up these chips we found. I assume they'll have some strictures on the resale of these chips, whether they're effective or not. Who knows? Probably not, because as we've seen throughout the Biden era chip controls, it's just very, very hard to put a net around this stuff. And the Chinese are very diligent. They have a very good network of, ways to move products underground, for all kinds of products. In fact, China is struggling with smuggling of rare earths through their export controls. So it goes both ways. And I think it's just very hard to bottle up the tech in terms of both the hardware and the IP.
So, yes, with the IP, which was part of the Phase 1 2020 trade deal from Trump 1.0 administration, how much more difficult is it going to be in this day and age and in this environment to track and make sure that that intellectual property is not being essentially duplicated or replicated, I should say, within that region, that would then create even more of a competitive headwind for some of the companies that want access into the region, but also want to make sure that they're still securing their own competitive advantage.
Right. On a scale of 1 to 10, it's about a 12 in terms of difficulty. It's impossible, basically. So we're going to hear a lot from Treasury Secretary Bessent and from the president and others about this phase one deal and sort of putting that Humpty Dumpty back together in coming months. And I think your viewers should keep in mind, we can force China to buy more soybeans and buy more aircraft and things like that. But in terms of any of the so-called structural reforms, whether it's cracking down on theft of intellectual property or getting China to reduce its subsidies to the winners it picks in its export sector, or getting China to rebalance its economy to more consumption. These are all complete and utter fantasies. I don't believe the Trump administration believes any of this stuff. We saw that phase one deal went nowhere. It was completely not enforced, but China really, I don't think, had any intention of ever doing anything beyond buying a few more soybeans. So all of that is, it's fake. It's fake news, you might say. But that might not stop it's something the Trump administration can use if they need to sort of justify a punt, which is what they've done for 3 months at this point. Whether it extends longer, there's a lot of variables, that we'll see over the next few months that'll play into that.
Markets digesting the U.S. and China's 90-day trade truce. Joining us now, Stephen Roach, senior fellow at Yale University's Paul Tsai China Center, and Greg Ip, chief economics commentator, deputy economics editor at the Wall Street Journal. Thank you both for joining us this afternoon. Stephen, I want to start with you. Obviously, these are negotiations and not deals. The stock market may be trading like they're deals, but they're still negotiations. What do you think is the likelihood of the final deal between the U.S. and China looking like? This truce, this negotiation?
Well, I don't think we have any idea right now. I think it's clear that the president has flinched, blinked, whatever you want to call it, relative to the outrageously high tariffs he had slapped on China in a fit of anger after China dared to retaliate from Liberation Day. But, I think there are certainly good grounds for the U.S. Continuing to put more pressure on China through higher tariffs than it will for other trading partners. This is a mistaken view from my perspective, because the idea of imposing a bilateral penalty on one nation to try to bring down a large multilateral trade deficit with over 100 nations just won't work. But that's the mindset that prevails in the Trump administration and in Washington as large. So, I think you can certainly look for China. If Trump settles on 10% universal tariffs, and for the world as a whole, he's going to hit China with more than that.
Greg, I want to bring you in here as well. Title of your column this week, Greg, which I read, Trump's China deal makes sense. How he got here doesn't. Walk us through that, Greg. What do you mean?
Well, at the end of the day, we're ending up, when you include the tariffs that Trump inherited from the previous years, you add the 20% tariff that was added for fentanyl, and now the 10% reciprocal tariff. The effective tariff, once you account for all the various exemptions, is about 39%. That's really high. I mean, it's the highest tariff we've ever had on China, the highest tariff we've had on anybody for a very long time. And it looks like it'll be much higher than any other country has. And I think that's appropriate. I think most people on both sides of the aisle think it's appropriate that China is not like any other country, that it is a geopolitical adversary. It doesn't play fair on trade. It discriminates against Western companies, and it wants its natural champions to dominate technology. It makes sense to treat China worse. But the way we got here doesn't make any sense at all. I mean, to start at 34, go to 145, drop it at 10, and drop it to 10%. That's just the reciprocal piece, I should say, and get nothing in return for dropping it to 10. I think kind of really sort of like the racist questions about just the quality of Trump's deal making and, whether there's any internal rationale to any of what he's been doing.
Greg, I want to just bounce one argument off you because I'm just interested to get your thoughts on it. The way it's framed right now by a lot of folks is that Trump retreated, and maybe he did. But it was interesting. My buddy John Carney makes another point, and John pointed out, and I want to get your take on this. Maybe it's not a retreat, John says. Maybe it's a pause. It's more like a strategic pause, is John's point. And Trump takes these 90 days, Greg, and he'll try to punch through these other measures, punch through tax cuts and deregulation. He lets Bessent keep playing the role of sort of, good cop. But if Trump doesn't get what he wants, and Xi does not deliver what he would consider material concessions, maybe Trump comes hitting right back and reimposes tariff escalation. What do you think about that argument?
Listen, like Steve, I have no idea what's going to happen over the next 90 days. I think that where we are today is probably a pretty good bet on where we end up. But sure, negotiations could break down and tariffs could go back up. But just because there's more to come doesn't mean it makes sense to how we got here. There's nothing that could have stopped the president from just starting at 10%, if that's where he wanted to end up, and then ratcheting it from there instead of effectively doing the opposite, therefore conveying the image, whatever you think of the reality, that he capitulated.
And Stephen, I want to bring you back into the conversation because to the point that Greg is making, one of the key questions from the investors on Wall Street who I talked to, they just want to understand what the goal was of these tariffs in the first place so that they can have a framework for thinking about the administration's moves going forward. Where have you gotten clarity on the administration's specific goals when it comes to trade deals with China?
Well, first of all, I have to say I get much more clarity over the years in reading Greg Ip in the Wall Street Journal than I do from reading the policy statements from the White House. But his point on how we got there is absolutely critical, and the message is not in the actions that President Trump has taken, but in this sort of strange philosophical view that he has addressed, that America's been ripped off for decades, and we're going to put a price tag on the ripoff in the form of these 10% minimum or universal tariffs, as he calls it, and that is the price that we're going to charge the rest of the world for taking advantage of us. And that is a really high price relative to the tariff rates that have been that we've been running over the last 30 years, which if you look at the numbers put together by a group at Yale, the Yale Budget Lab, our effective tariff rate for the rest of the world has been a little less than 2% over the past 30 years. So we're going to go from 2 to 10. That's a 5-fold increase. That's a huge tax on our companies and on our trading partners, and not without significant impacts on the broader global economy. So there's not a whole lot of strategic wisdom in this approach, in my view.
Kevin, I want to bring you back.
Can I just say how much I agree with what Steve just said? I can make a case for why we should have a 39% tariff on China. I cannot make a case for why we have a 10% tariff on Great Britain. I mean, in fact, if you look at the actual underlying rationale, the 10% tariff on China is the same as the 10% tariff on Great Britain as part of the reciprocal tariff action announced on April 2nd. What was the purpose of that action? Supposedly we were going to punish countries that were running unacceptably large trade surpluses with us. China is a geopolitical adversary with a huge surplus with us. Britain is a stalwart ally, our best ally, with a trade deficit with us. And they both get 10%. I mean, what message does this send to the world about how the United States picks its friends?
Well, Greg, it's a great point, but before we let you go, I want to get a sense of how this impacts the consumer. Kevin Gordon with Charles Schwab was telling me earlier this week that we could actually see a bigger pass-through of inflation, of costs to consumers with this lowered potential tariff rate because companies are more willing to pass on a 39% rate than they were a potential 145% rate. Greg, how do you view that? Are consumers going to feel inflation more even if some of these tariffs are negotiated down?
it's definitely the case that 145%, which Treasury Secretary Bessent said was like an embargo level, trade just comes to a halt, so nobody pays that tariff. So, however, if we compare today with where we were, say, on January 20th, yes, at some point these tariffs will pass through to consumers. They will pay this. Now, how big will that effect be? That part's very hard to say. And I will say, in fairness, that the April CPI data that we got just a couple of days ago shows that the pass-through from tariffs so far, it's there, but it's small. So maybe it will not be perhaps the economy wrecker that a lot of us were worried about a month or two ago.
Stephen, Greg, great to see both of you today. Thank you so much.
Thank you.
An event in the Middle East. President Trump said India has offered to remove all tariffs on U.S. goods. This comes as U.S. and Chinese officials met in South Korea. It's the second known round of talks since the two nations agreed to a 90-day pause on reciprocal tariffs. So what does this mean for the future of trade between the two nations? Joining us now, Leland Miller, China Beige Book co-founder and CEO. Leland, great to have you here. I could use some help getting clarity on whether the negotiations are going to look like any potential deal. How much confidence do you have that this 90-day truce could look more permanent?
It all has to do with what a deal means. If it's simply a deal that, freezes the situation at these levels indefinitely, sure, the Chinese will be glad to take it. If it's building to a phase 2 deal, then what does that look like? Is it just more commodities buying, in which maybe some things sprinkled on top, fentanyl cooperation, a little a give on TikTok? The Chinese would love to take advantage of an offer like that because it's going to just drive more bilateral flows in China's direction and it'll relieve the pressure. If there's more of an ask for structural changes, those are things that the Chinese are not going to grant in a trade negotiation. So all of it has to do with what the administration's demands are for a deal. If they want any deal, they can get a deal. But if they want a good deal, that's a different story.
Who has the upper hand right now, Leland?
Well, that's a little bit tricky. So in a strictly bilateral face-off, the United States would have enormous advantages. But on the other hand, this isn't just a bilateral face-off. There's a lot of other tariff negotiations going on in the background. And one of the things that I think is being ignored right now is that with China's tariffs being brought down so significantly, but the threat of Southeast Asian tariffs and others staying elevated, you have the potential that if they don't have deals done in the near future, then all the production that had been moving out of China to diversify supply chains for national security purposes and other reasons, all the production that's gone outside of China could flow right back in. And so the administration, while trying to play tough on Southeast Asia, could end up empowering China and blowing out the bilateral trade deficit by the end of the year. So a lot of forces at play here.
And my guest host, Tim, has a question for you as well.
Leland, I guess, you look at this 90-day pause that we've seen. I think obviously investors have gotten very excited about that. Longer term, what does this look like? Is it 30%? Is it 40%? What would the U.S. And China be happy with where it's a win-win situation?
Well, happy's a relative term, but I think that the contours of this are quite wide. When you have tariffs that are above 60, 70%, then it's prohibitive. You're effectively decoupling the economies. There's a lot of economic hits, which means there's political pain. If you want to get much lower, then of course you're looking around the world and you're saying, wait a second, why are we giving China, which is supposed to be the big bad guy, a better trade deal than some of these other countries? So, there's a rather wide window depending on what the administration wants in terms of how this settles. But again, it all depends on what else do they want. If this were just about tariffs, there's a level we could predict. But if it's about other aspects of the relationship, if the phase 2 deal is going to be about more purchases or about sectoral decoupling, it's about other things, then tariffs aren't the whole story.
Well, let's talk about exactly that, because there are these non-tariff barriers and things like chip export controls are coming up. Beijing officials calling the U.S. bullying on AI chips as legislation is put forward to continue to curb China's access to the most powerful AI chips. How do you see that impacting a company like Huawei going forward, a Chinese-based company, amid the engulfing of chips names in the trade war?
Well, the mistake on Huawei is not that we didn't identify the problem a number of years ago and crack down on it. It's that their loopholes developed. Huawei found ways of getting these chips, both directly and especially indirectly, that it needed in order to build back up its empire. And U.S. administrations have sat idly by and let them do this. And so now we have Huawei returning as a powerhouse. The Chinese tech sector has got all the chips it needs with multi-year stockpiles. It shows a lack of seriousness on export controls. A lot of talk, not that much action when it comes down to it. So if folks want to get serious about this, they have to realize that export controls can't be Swiss cheese. They need to actually cut the problem off that they want to cut off.
Well, Leland, you look at this from an investment lens here. Let's say we do get to a 30 or 40% level. What type of impact on growth does this have for the U.S.? What type of impact does it have over in China?
It depends on what tariffs are on the rest of the world. If the purpose of tariffs on China is to diversify supply chains out of China because you don't want Beijing to have a stranglehold or choke points on your supply chain, then you shift the production to other places. Plenty of countries are ready to take it. You've got India, Southeast Asia, you've got Mexico, plenty of other ones. If you've got elevated tariffs elsewhere, then it sort of changes the nature of the game. So you have to figure out what your priorities are when you're doing this. There's a short-term hit from tariffs at times, but that doesn't need to be a long-term hit. There just needs to be a thoughtful sequencing of these tariffs.
Leland, thank you so much. Really appreciate you joining us this morning.
Pleasure.
It's time now for today's strategy session. Stocks opening in the green today as tariff concerns move to the back burner for investors. However, the president did reveal he plans to send out tariff plans for trading partners in the coming weeks. So, should you stick with U.S. stocks or look to emerging markets? Joining us now, Jeffrey Kleintop, Charles Schwab's Chief Global Investment Strategist. Jeffrey, always great to have you on here. So, given the backdrop that we're in, the pending tariff negotiations to come, do you buy U.S. or do you go global?
I am concerned about the magnitude of the rally we've seen coming back. The markets just might be a little too enthusiastic that the trade worries are behind us. Remember, in the first Trump trade war with China, after a 90-day trade truce that began on December 2nd of 2018, the two sides did not resolve their differences and tariffs increased again. And, the trade frameworks so far are far from completed agreements. They can take a long time. Also, this semiconductor tariffs and related hardware supply chain, along with pharmaceuticals, are now out of their comment periods. Those ended May 7th, and the new tariffs could be announced at any time. So I'm a little concerned about leadership that we're seeing in the markets right now, particularly in tech hardware. I think that's vulnerable. Instead, I am looking to emerging markets. They're outperforming this quarter. They outperformed last quarter. And you know what they did in every single quarter of Trump's first year of his first term, as we saw better growth out of China and other parts of the world. That's echoing in a lot of what we're seeing so far this year. So I think we could continue to see emerging market outperformance along with European outperformance of U.S. markets.
Does that mean that you're trimming some of the U.S. exposure or just holding for now?
I think if you're an investor that over the last several years has really let your U.S. and tech exposure really drift to be a dominant portion of your portfolio, it is not too late to rebalance. Europe, emerging markets have outperformed this year, but only by a small amount relative to the last, say, 10 years. So I think there's still room to move your portfolio more into emerging market and developed market equities.
And I wonder, too, how you're thinking about emerging markets like China. We obviously had Michael Burry of Big Short fame out with his 13F filing indicating that he is trimming exposure to Chinese stocks. To what extent do you think investors should follow that move?
I think China's still got some room to go. Look, China has really been a dismal place to invest for the last 3 or 4 years. Valuations are way below their long-term average. And this year, China has 3 budgets. And if you combine the 3 of them, you get total deficit spending equivalent to 11% of GDP unveiled this year at China's national leaders, their National People's Congress meeting back on March 5th. They've only just started to implement that after April 2nd. So we're just starting to get the data on this massive amount, record-breaking amount of stimulus in China to turn around the 40 to 50% of their GDP that is consumer spending. Remember, only 3% of China's GDP is tied to U.S. exports. So if they can really turn that around, that can continue to mean strong momentum for Chinese equities, which are already up nearly 16% this year.
It's not too early to start thinking about next earnings season because that's when a lot of companies are going to be giving us some updates on where they ultimately performed, given the amount of clarity, or lack of clarity, I should say, that they were citing in this most recent and this current still yet to end, as we're waiting for a few more retail names that are going to be scattered over next week, and then a few other companies trickling out. So what does that set up for the next earnings season, and whether there is certainty that's put back on the table?
Obviously, we heard a lot this earnings season about the uncertainty and maybe two different paths that earnings could take for many big companies. We are still in the European earnings season. It tends to lag those in the U.S. We're only about 2/3 of the way through it. So we're hearing these comments way post-Liberation Day now on what they're seeing going forward. Of the 230 companies in the Stock 600 index in Europe that have reported earnings so far, 60% beat estimates in 60% beat estimates in the first quarter. That's 6% better than usual, and the guidance has been improving here in recent weeks. As a matter of fact, we continue to see rising earnings estimates in Europe in contrast to maybe the downgrades that we saw in U.S. earnings growth. So I continue to favor European stocks on that rising earnings and economic growth backdrop, the combination of fiscal and monetary stimulus this year, regulatory reforms as right-leaning governments elected last year begin to implement policy along with attractive valuations and relative political stability adding to a rising euro.